Hey, happy Saturday to everyone. Hope you had a great week. I hope you didn't get hung out to dry by taking one side or the other. It was definitely a challenging week, as we sort of expected when we did the last video. With that options expiration being huge, a lot of open interest on both sides, and it was bound to be a choppy week with the Fed involved as well. But anyway, we're going to get into what happened. We're going to unpack all that and then look forward because that's what markets do. They don't look back. But first, let's do our disclosures. This is not investment advice. This is just some educational trading video. You need to continue to trade your own analysis and convictions, not mine. I am frequently wrong, as we all are, and take everything with a grain of salt. Just try to implement things that you find valuable from this, and I hope you do. But anyway, let's go on ahead and get into it. So this was last week. You may remember I said in the last video 4,700 was huge. We had pretty much closed on it last Friday, a little bit above. Everybody was very confident going into the next week. I posted a couple times on Twitter that not to get too excited about things because it was options expiration week. We had a lot of open interest in the put side and the call side as well at that 4,700. We had a Fed meeting on Wednesday. It was going to be a rocky week. I did not expect a breakout at all, unless we could get firmly above that 4,700, which we did not really. Futures tried to make a push the night after the Fed, so Wednesday night, Thursday morning, really, during European trade, but alas, it was sold off and we went back down. And this is where we closed. And if you remember my lines, I've now moved them. We're now working on the January options series. So that's where my levels have moved to. But you may remember I had a big green line here, and I had a green line, I believe, somewhere in here at 4,500, or a red line, excuse me, for the nearest put level. And we stayed in that range. So options market tells you a lot. I am a firm believer that, in the short run, right, not the long term. The long term fundamentals play out, right? The market goes where the fundamentals are. Markets are, I believe in the efficient market theory. They price in all known information efficiently and adjust accordingly as that information changes. It's that simple. So expectations versus reality. If expectations are too high and reality is lower, markets go down, and vice versa. Most of the time, expectations are too low, reality is higher. But that's not what we're talking about here. We're talking about trading. And in the short run, I believe the options market pretty much runs the show. I almost believe that stocks, it's kind of a joke that people put out there, stocks have become a derivative of their options rather than vice versa. I actually kind of put I think there's some weight there, some validity to that statement now in the very short periods of time. So we've moved. I did some research this morning. Right now, when you get early into an options series, let me zoom out a little bit. There we go. Nope, still. When you get early into an option series, there'll be a lot of weird things that come out. Like right now, if you can see this, let me see if I can get it. There we go. The highest put and call level are both at 4,000. And I believe last week that level, both the highest call and the highest put level, was around 4,700. And so that's probably why we backed off that level, and the bears kind of won. Now, moving into this one, the wheels kind of come off, so I'll end up updating this weekly. And so this might change, right? But right now, that's where it sits. It's like a huge straddle, essentially. But we're way up here, so I'm not as concerned about that unless we start moving down quickly, which is entirely possible. The bears have a pretty good case right now, I would say. For the short run. Long term, I think they're cooked. But anyway, so one positive here is that the nearest put level is now 4,600. So there's a lot of open interest at that 4,600 level. It was probably loaded up this week for January. We're still at 4,700 on the call side. And so, that's going to be our short-term sort of resistance still, obviously. I've got a few other lines. This is actually max pain for at the current moment. This will move. All this stuff is subjective to market movements. So, every week I'll move these levels a little bit if they move. But for now, that's where we sit. So, as you can see, technicals, if you're a purely technical trader, which I'm not, I look at technicals because it's sort of just showing me what happens so I can try to figure out what what's going to happen next. But you've got to remember, technicals are not predictive. It is just showing you what happened. But this is not a very good technical setup for buyers, or I should say for bulls. I think it's a good buy setup actually. But you've got a double top, so the bear case is strong. We bounced off of that level. We dropped, off of it. But the positives here, I think that what gets ignored a lot if you're a TA guy is the slopes. This is the 60-day moving average. I use that instead of a 50, and we are still above it. And the 50, obviously, the 50 would be, I believe, somewhere in the same vicinity, maybe right there. The 200 days down here sloping positive, so we're still in an uptrend regardless, and we're really, as bearish as this little pattern here looks, we're not that far from all-time highs. So this is your all-time high. This is your current level, and to be watching, we need to be firmly above it to really be confirmed. So, but you can see both sides here. It is very confusing, and that tends to happen on these options expiration weeks, like we had this past week, where it was really choppy. But in reality, down for the week by 100 points. You can look at, let's go see how this options expiration candle finished out actually. This might be hard to see with all my little drawings. Yeah, it is. It ended up being red. Let me hide the drawings. I don't want to lose them though. Sorry. I bet if I switch over to ES, I'll be able to do this. Let's just do that. Okay. Sorry for the jumble. All right. You can see that the options expiration candle, you may remember me talking about this in last week's video. I always look at where we close out. We did not close, at the highs, but pretty near. You can see it's an ugly candle, but I can show you a few other ugly ones when we're in a clear uptrend like this that didn't really play out for the bears. There's one. There's one. You had sort of a dead month. Let's see. Here's another one. You had a nice pullback here in September. But another thing I will say that plays to the bears' favor, is this. This was last February. We all know what happened in March. Or during the late February, most of March. I just don't see that there's any fundamental reason for this to happen again, for this to repeat. So if you're just a technicals guy, you can find these little patterns, but you have to have something to back it up, some sort of fundamental reason for it to turn. And one could make a case for the Fed announcing the 3 interest rate hikes for next year. So we'll be at about a 1% Fed funds rate by the end of next year. Of course, they will back off of that, I would imagine, just because they always do. But one could say that that's going to be hard on the growthy stocks like the NASDAQ 100 guys. But you have to put that into perspective as well. During the late 90s, from 95 to the top in 2000, the Fed funds rate was above 5%. So just think about that for a minute. And growth stocks went nuts, obviously. That was the tech bubble. So they were working with a 5% Fed funds rate, so very high borrowing rates, and those growth stocks still excelled. So don't count out, a big bull run into next year. But I do believe that next year is going to be a choppy one for a number of reasons. I think, it has been on average, and if you've read anything I've written, I wrote a while back that on average we have a 10% correction once every maybe 10 or 11 months. We usually have 4 or 5% pullbacks a year, one of those extending to 10%. That's really the rule of thumb. This year we've had now 5% pullbacks in the last 12 months. So we're overdue for a little volatility, I would say. Now, remember, for your investing purposes, you don't care. You shouldn't be worried about corrections for your investments. Those are, especially if you're buying every 2 weeks on your payroll or your paycheck, with your 401k. You're not trying to time corrections because they're virtually impossible to time. Some people get them right. You might get one right. You might get one wrong. Missing out on gains if you have a long time horizon is worse than maybe clipping a 10% correction off. Something, but for trading purposes, you definitely, when you get stretched like this without a correction, you really had to, you can be bullish as you want, but you need to be cognizant of those patterns, those long-term sort of trends that, it's okay to have a 10% correction, for your investments, but for your trading, it can be disastrous. You can blow your account up in a 10% correction. So you got to, look at both sides all the time, be cautious in the short term, because if you get bit by one of those, you're in big trouble. I don't think we're going to have one here. I think we will have one sometime in early next year, maybe February, after we make a nice bull run. I believe we're going to hit 48.50 here before the end of the year, and probably around 5,000 in February. But anyway, moving on to the trading aspects, I've been talking a lot about sort of intermediate trends there and things like that. Targets, their targets are only as good as as what the market does the next day to change them. But anyway, so let's take a look. Couple things. Actually, I wanted to go over and look at a volume chart. This is a volume profile. This is huge right now on FinTwit. You'll see a lot of guys talking about showing something similar to this. It shows the big volume ranges and so on. And I do like this. I'm learning more about it every day. It's sort of auction theory. I'm reading a book on it, trying to get my brain around it a little better before I start talking more about it. But I do find these big volume areas. This is where volume is condensed in a section, in a zone. They are going to be your resistance and supports, these big levels. You're starting to see this area build up. This is the area between, say, 4,600 on the futures and 46.36. And if you were watching on Friday, it pretty much stayed in that range the whole day. And so I've been talking about this 46.50 level for a long time. And it is still important, because above that we get into this chunk, and really you got that midpoint, which is that 46.76. For bulls want to get this above here ASAP. You'd like to see a gap up rally, maybe open SPX somewhere around here to where there's no actual gap, with a big follow through above this, with buyers coming in above, willing buyers, not just people covering shorts like we saw here. That was clearly a short covering rally. That those tend to fail. If you don't find active buyers when you get up in this level, it's not going to break. And I fully expected it. I actually was long in here, and I saw something that night, probably right around here. This is where I took my longs off, killed all my calls. I had calls. I had a long on ES. I saw a sell order come in Globex while I was sitting here with my kid watching TV. I think it was something like 1,000 contracts at market, moved it 5 points in a couple of seconds, and I said to hell with it and killed my longs. And I missed out on some, sure, but yeah, there. And this was I was able to reposition in here, and so I'm currently sort of delta neutral, with maybe a little bias to the upside. I've got that long on ES hedged with a back month. So I'm long a March and I'm short a June, and so that position is neutral, but I have a lot of calls that I bought yesterday on the way down that are underwater at the moment, but I'm looking up here. I also have puts to cover my long. So I believe my delta is like 7 right now. But that means that, but when we open up Sunday night, I was covering myself from a Sunday gap because I feel like we're sort of in danger of that, like a Globex Sunday night gap down. I wanted to be sure I was covered. My stop, as you can see, is here. I also have a stop on my June, the short that I have somewhere in here. Just wanted to cover myself. I did not want to get caught out with a big gap like we had last February. I told you we are at risk of that right now. There's a lot of potential negatives out there, and I just don't want to be caught. And so I'll probably donate if we do gap up and we start moving up. I'll just donate $500 to the cause by losing that hedge that I did that June short. That's fine with me. But if we gap down, ostensibly, if that stop is run, I think we go down pretty quick, and I'll make back some, on the drop. But anyway, that's what I'm looking at. There's one other thing I wanted to point out. Let me pull up Russell. Russell's been getting killed. I don't know if you noticed, but everybody's talking about the negative market breadth, and that being a good strong reason for, a good strong case for the bears. And it's right. It has been right. The Russell's something like 12% off its highs from here to here, so it's in a full correction. But I tend to believe that that those corrections, as I mentioned, happen every so often, once a year. So that's normal. I don't think that the Russell's going into a bear market. I think that small cap stocks are not where you want your money at where we are late cycle, whether you believe it or not. And you tend to want to be in the mega cap growth stocks late cycle. They're going to get the most attention, not the small cap. But what I did see positive here is it has a nice little reversal formation, potential reversal formation. It had a strong day. I believe it was up 1%. Yeah, 1% on Friday while everything else was down. And so that sort of divergence or poor breadth that we'd seen for weeks and weeks and weeks was upset on Friday. And I believe Kathy Wood's little ARC things have been getting killed all year. ARC funds were very positive as well. They got a lot of like your Palantir and things like that. Palantir was up like 4% on Friday. So a lot of the stuff that had been getting trashed for the last few weeks was up big, while the market in general was down. And so that's a positive thing for the bulls, but it's still in a correction, and you still have this about to cross over here. If you're a technicals person, you look for those crossovers, but we should suction up to that level on Russell, I would say, if the rally continues. 2250 is where you want to watch. This is the Russell futures. So keep an eye on that, because if we get a breakout there and then coincidentally get something going on here in the NASDAQ 100, which has that same more bearish setup than the ES right now. But if we can, it did hold above that 60-day. If we can get a rally in that, along with a rally in smalls, and you start seeing that breadth shift back, it can be explosive and could just run up into the end of the year. That's what I'm looking for. So moving forward, be cautious. Again, I always say that in the short run, be very cautious. I've kind of laid out both sides for you, so you know what to expect. But other than that, have a great week. Let me know if you have any questions about anything I've done here. And yeah, good luck to everyone.